Income splitting. The idea is simple. If you're making $200,000 and your spouse makes $50,000, you're getting hammered by progressive tax rates while your spouse is chilling in a lower bracket. So what do? You shift some of your income to your spouse. Maybe you hire them as a consultant for your business, or you structure your investments so the income flows to the lower earning spouse. Suddenly, instead of you paying top-tier tax rates on everything, you're both sitting comfortably in middle tax brackets. The key is making sure the income shift is legitimate. You can't just randomly decide your spouse earned half your salary this year. But if they're actually helping with your business, or if you structure your investments properly, you can legally move income around your family like pieces on a chessboard. And here's the beautiful part. It works with adult children too.
Hey, what's up, ladies?
Got a kid in college earning basically nothing? Congratulations, they're now your business partner. Pay them a reasonable salary for actual work, and you've just shifted income from your 40% tax bracket to their 15% bracket. Capital gains timing. So you've got some stocks that have done well and some that have tanked. Most people just sell randomly whenever they need money, but you're smarter than that. Here's what you do. You plan your sales around your income. Let's say you're expecting a low-income year because you're between jobs or taking a sabbatical. That's when you cash in your big winners. Instead of paying capital gains tax at your usual high rate, you're paying it when you're in a lower bracket. You can also time your sales to stay within certain income thresholds. In the US, if your income is low enough, you pay 0% on long-term capital gains. It's like the government is rewarding you for being strategic about when you sell your investments. The trick is thinking of your investment sales as income you can control. Most of your salary is locked in for the year, but you decide when to realize capital gains. It's like having a volume knob for your taxable income. RRSP and 401k contributions. This is the closest thing we have to actual time travel. When you contribute to an RRSP in Canada or a 401k in the US, you're literally sending money to your future self at a discount. Here's how it works. Every dollar you contribute reduces your taxable income today. So if you're in a 35% tax bracket and you contribute $1,000, you just saved $350 in taxes. But here's where it gets interesting. You're betting that when you retire, you'll be in a lower tax bracket than you are now. So you're avoiding high taxes today and planning to pay lower taxes later.
You can't touch this.
The annual contribution limits are generous too. In 2024, you can contribute up to $23,000 to a 401k if you're under 50, and even more if you're older. That's potentially $8,000 in tax savings if you're in a high bracket. Tax loss. Harvesting. This is the art of making your investment mistakes work for you. You know that stock you bought that immediately tanked? Well, congratulations. It's now a tax-saving opportunity. Here's the strategy. You sell your losing investments to realize the loss, then use that loss to offset your capital gains. If you made $10,000 on Apple stock but lost $3,000 on that crypto disaster, you only pay taxes on $7,000 of gains. Now, if your losses exceed your gains, you can use up to $3,000 of losses to offset your regular income. And if you have more losses than that, you can carry them forward to future years. The key is rebalancing smartly. You can't just sell a stock and buy it back immediately. That's called a wash sale, and the IRS will disallow your loss, but you can sell Apple and buy Microsoft, maintaining your tech exposure while harvesting the tax loss. Business deductions. If you're self-employed or run a side business, congratulations. Huge chunks of your life just became tax deductible. That home office where you answered emails? Deductible. That business trip where you happened to visit some nice restaurants? Deductible. That new laptop you needed for work? You guessed it, deductible. The home office deduction is particularly sweet. You can either deduct actual expenses, a portion of your mortgage, utilities, insurance, or use the simplified method of $5 per square foot. Either way, you're turning your living space into a tax shelter. Business travel is another goldmine. As long as the primary purpose is business, you can deduct flights, hotels, meals, and transportation. The trick is documenting everything and making sure the business purpose is legitimate. That conference in Hawaii? Totally deductible if it's relevant to your business. Equipment and supplies are the low-hanging fruit. Computers, phones, software, office supplies. If you use it for business, it's deductible. And with Section 179 expensing, you can often deduct the full cost in the year you buy it instead of depreciating it over time. Incorporation. When you incorporate, you're essentially creating a separate legal entity that can be taxed differently than you personally. So corporate tax rates are often lower than personal tax rates, especially for small businesses. So instead of paying personal income tax on all your earnings, you can leave money in the corporation and pay the lower corporate rate. But the real magic happens with income splitting. You can pay yourself a reasonable salary, then distribute additional profits as dividends to family members who are shareholders. Suddenly, you're spreading income across multiple people in tax brackets. You can also control the timing of when you take money out of the corporation. Having a low income year? Take out more. Having a high income year? Leave more money in the corporation. Dividend income. Dividends are payments made to shareholders from a company's profits, and in many jurisdictions, they're taxed more favorably than employment income.
How? Why is this a thing?
Here's why. Dividends are paid from after-tax corporate profits. So to avoid double taxation where the same money gets taxed twice, governments often give you a tax credit. The result? You might pay 15% tax on dividend income while paying 35% on the same amount of salary. But you still need to pay yourself a reasonable salary for any work you actually do. The tax authorities aren't stupid. They know people would pay themselves $1 in salary and $200,000 in dividends if they could get away with it. The sweet spot is paying yourself a reasonable salary for your work, then taking additional compensation as dividends. Real estate depreciation. Real estate depreciation is one of those tax strategies that seems too good to be true, but it's completely legal. The government lets you deduct the theoretical decline in value of your rental property, even if it's actually appreciating. Here's how it works. You buy a rental property for $500,000. The government says the building, not the land, will lose value over 27.5 years, so you can deduct about $15,000 per year for depreciation. This reduces your taxable rental income, even though your property might be worth more each year. The beautiful irony is that you're getting tax deductions for depreciation while your property appreciates. And when you eventually sell, you can do something called a like-kind exchange, where you sell your property and immediately buy another similar property, rolling your gains into the new property and deferring taxes indefinitely. Home sale. Exemption. In the U.S., you can exclude up to $250,000 of capital gains from the sale of your primary residence, $500,000 for married couples if you've lived there for at least 2 of the past 5 years.
Slow down!
The best part? You can use this exemption every 2 years. So you could theoretically buy a house, live in it for 2 years, sell it for a tax-free profit, then repeat the process. Charitable donations. Charitable donations are the feel-good tax strategy that actually works. You help causes you care about while reducing your tax bill. The key is understanding the limits and timing. You can typically deduct donations up to 50% of your adjusted gross income, and you can carry forward unused deductions for up to 5 years. So if you have a high-income year, you can make a large donation and spread the tax benefit over multiple years. But here's the advanced strategy. Donate appreciated assets instead of cash. If you've got stock that's doubled in value, donate the stock directly to charity. You get a deduction for the full market value, but you never pay capital gains tax on the appreciation. It's like getting a tax deduction for money you never actually spent. Trusts. Trusts are like the Swiss Army knife of tax planning. They can help you control how assets are distributed, protect wealth from taxes, and even provide benefits to multiple generations. A family trust can be particularly powerful. You can transfer assets to the trust, which then distributes income to family members in lower tax brackets. It's like having a permanent income splitting arrangement that can adapt to changing circumstances. Discretionary trusts give you even more flexibility. The trustee can decide who receives income and when, allowing you to optimize tax outcomes based on each family member's situation in any given year. Did you enjoy this breakdown? Then please subscribe and hit the bell for more.